We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard from EMA2 Equity Management Associates, and also the author of the new book, The Big Print, What Happened to America and How Sound Money Will Fix It. There's the book. Larry, how are you today? Thanks for joining me.
I finally have a printed book. Thank goodness. It took 7 months of blood, sweat, and tears, and it was a lot harder than I thought. I'm never doing this again, Tom. It's a one-shot deal.
It sounds so fulfilling, Larry.
It'll be fulfilling if it works. I mean, I felt driven to do it, which we'll talk about, but and I felt like I kind of got tapped on the shoulder. I had something to say at this point in time, this period of time economically, that I think is important. And so I just thought, you know what, I gotta tell this story. Mm-hmm. And so I did. But like I say, it's a one-shot deal. I have a newfound respect for anyone who writes a book. It's not an easy process, not at all. But anyway, so here we are.
Well, I think it's a big part of what a lot of people are expressing to me lately is this idea that I feel like something is wrong, but I don't quite know what's wrong. So I think tools like this or books like this that give people a digestible way to be able to understand a little bit more about what is wrong, how it went wrong. And I think the most important part about what you put together here in the book is also some solutions to this problem.
Yes.
Because
yeah, right. I mean, it's just talking about the problem is depressing.
Well,
right?
I've read a lot of books in this arena that don't provide any actual solution.
Yeah. Well, thank you. Yeah, no, I tried to do that as well. And of course, a lot of people are going to argue with me about the solution, but this is just my best guess at the solution. And we don't really know how it's going to unfold. And as you and I have both talked about many times, there are two forms of sound money. There's gold and Bitcoin, and they both are part of the solution. And I'm a big proponent of both. But obviously I lean a little more heavily towards Bitcoin for some obvious reasons. But yeah, let me just, if I can, let me just tell you why I wrote the book. I was watching some of the US political debate in early 2024 now. And it was so frustrating to me that I saw Team Blue and Team Red screaming at each other over stuff that I thought wasn't really the problem. It was kind of like the house is on fire and they were arguing about the color of the draperies, and I thought, come on, guys, you're really missing the underlying issue, which is the monetary system's all messed up and has gotten more messed up. It's getting worse. Mm-hmm. And, I thought, you know what? I thought I was maybe uniquely positioned. We'll see if the market agrees, to tell my view of how that monetary system got screwed up, and then to propose very positive and constructive solutions about how we can fix it and how it'll even get fixed without this book. I mean, one of the great themes of the book is the way that this fourth turning is evolving towards decentralization, and the internet and decentralization that's taking place in society is a really good and positive thing. I mean, the fact that people are now getting their news from people like you and people like Joe Rogan and people like Tucker, and there's an alternative voice to kind of the mainstream, big media, big pharma, big, food, big everything, centralized world that we've lived in, where, a lot of mistruths got told. And so people were misled. And thank God for the internet. Do you know what I mean? It's really going to save us, in my opinion. And that's the positive part. So that's, yeah. And I should say, one of the things I did, there've been some great books written on this topic. It's like, this isn't original. And by the way, I use some of those books and the information from those books. What I thought, Larry, what can you bring to this that's maybe a little unique or different? Because I've given out these other books, and often they're a little more technical, a little more complicated. And the average American that I give them to, they bog down. They start reading it like, God, I don't want to read about monetary policy. This is awful, And so I thought, well, what people do is they listen to stories, right? They watch, TV, they watch Real Housewives. They want to hear stories. They want a narrative of what's going on. And they don't want complicated language. They want it in very simple language that anyone can understand. And so what this book is an attempt to tell the story of how the money got broken through my eyes, my personal story, and in a way that, I hope anybody anyone with no monetary background could read it and get it and go, oh yeah, I see your point. And so as a test case, I used a lot of people who had no background in this area or weren't, heavily into this area. I said, read this. Do you understand it? And they came back, no, I don't get this. I don't get that. And my wife helped me with it extensively because this isn't her field. I mean, she was in, public relations and advertising and, just not into monetary economics. And, things that came out were like, I started talking about the Federal Reserve and it's like, what's the Federal Reserve? Well, okay, I better explain that, So it's a book I hope everyone can read and understand. That's kind of goal number one. And I think the sound money crowd, your gold friends, my Bitcoin friends, all of them, they'll all get it and like it. That's great. Mm-hmm. But what we really see is we all see this problem and we're kind of screaming about it. And the average person may not understand what the real problem is. And so I wrote the book really for the average person, hoping that they would read it and go, oh yeah, I get it. And even better than that, I think I might know a way to protect myself. So, So that's the thesis of the book. And I'm going to measure the success of the book based on average people, not based on hard money guys, because, folks, because we all get it, So
when does the book actually come out, Larry?
It's out. It's on Amazon right now. It came live on February 6th. Sales are taking place. There's a hardcover, softcover, and a Kindle version. I apologize. The first version of the Kindle was pretty bad. It didn't work right. It's fixed. There's now an EPUB file that works extremely well. And then there's going to be an audio file that's being recorded right now. A lot of people said, Larry, you got to record it yourself. I can't. I don't have the time. I've got a professional guy who's got a great voice. He's recording. It should be out very soon. So there'll be an Audible book. So I've had long haul truckers, email me and say, I can't read this thing. Can you give me something I can listen to in my truck? I'm like, yeah, it'll be done soon. So the book is out and it's selling and it's doing pretty well so far, but it's early days. And, I'm sending it to a lot of people, hoping that, media will pick up on it and maybe it'll catch some traction. Mm-hmm.
Well, we'll go over some of the main ideas today, but, there's so much of the nuance that gets missed in just chatting about it for a couple minutes here, that I really suggest, people pick up the book because it does give you a different perspective and fill in a lot of those gaps that you might not have known. So why don't we start by talking about where we originally went wrong? Was it with the creation of the Fed? Was it with Nixon coming off the gold standard? Where did we
those were
originally
two
go
big
wrong?
Bad events. I mean, it's the whole issue of the people versus the banks and the people versus the people who control the money supply has actually been around a long time. It was present in the 16 and 1700s as well, even when we were on the gold standard. And, probably the first big event that we went wrong was the War of 1812. Cost so much money that they had to suspend specie redemption to protect the banks. Mm-hmm. And so that became a recurring theme throughout the entire 19th century. Then obviously, when we had the Civil War, we couldn't really pay for that in a straightforward manner with taxation. So they created greenbacks, and Lincoln created a fiat currency that lost most of its value over time. But it got worse. And that's part of the story, that it's kind of gotten progressively worse. But, so the forming of the Fed allowed the banks to get levered up and provided them with a backstop. And, that was bad. And then Roosevelt grabbed the gold in the 30s. That was bad. But yes, the biggest turning point, and my favorite chart in the book is the chart of the inflation from 1800 to present, was when Nixon abandoned the gold standard in 71. I mean, that was huge, right? Because before that, we didn't have a perfect gold standard. Americans couldn't own gold, but we did have an international gold exchange standard. And if you look at this chart I'm describing in the book, and that's the reason to buy the book, by the way, is there are a lot of charts and the charts are important. And so the guy who's reading it is going to try and describe the charts, but a picture's worth 1,000 words, right? So if you get the book, you can see the chart and it's like, oh my goodness, we didn't have a real inflation problem in this country until 71. And then since then, we've had nothing but an inflation problem. So it really got worse with that. And the book goes on to point out that it's gotten worse since then. I mean, the book is titled The Big Print because I think the Fed is trapped in a cycle where every time we get over indebted, they have to print. And we've already really had two big prints. We had one following the bursting of the dot-com bubble when Greenspan took interest rates down to 1%, and they blew the housing bubble. So there was a print there. The housing bubble collapsed, and of course they bailed out the banks, and there was an enormous print there where money supply, or the Fed's balance sheet, went from under $1 trillion to almost $4 trillion. And then, of course, COVID was an even bigger print. And so, and of course that first print took 4 years, we added $3 trillion. Well, COVID took 8. Yeah. Oh, that's great, Tom. That's a fabulous chart. This is my favorite chart.
Yeah, we just put the inflation chart up.
Yeah, this is the inflation chart. I mean,
basically
look at what
CPI
happened.
being flat from 1800 to 1970, and then when we came off the gold standard,
Yeah.
just
I mean,
rockets.
and it's interesting though, flat, but notice how there were little blips, and those blips were all surrounding wars.
Yeah.
And the reason is that wars are very expensive. You can't really pay for them through taxation because people will revolt. And so what do? You print the money to pay for the war, and you have inflation. But the good news is that after each of those wars, kind of the inflation, generally speaking, came back down, less so after World War II. But then we really took off in 71. And boy, what a mess. And so, I mean, it's in my view, it's gotten worse, and we're heading towards some kind of a climax. I know, and you and I have discussed it before. One of my favorite books on this topic is The Fourth Turning. And it says that, every 80 years, countries go through an existential issue about how are things going to operate, and I think we're in a fourth turning right now. And I think the issue is the money system and monetary system. And prior fourth turnings were World War II, and before that, the Civil War, and before that, the American Revolution. So they tend to come about every 80 years. So we're in one right now, and it's getting kind of progressively worse. I mean, as in COVID, they grew the money supply 42% in 2 years. And that just really killed the average wage earner whose wages didn't go up by that amount. And think about it. You're a person who's worked your entire life. You've saved up money hard. You've done the right thing, stayed out of debt. And, suddenly, because of, a bunch of government policies, they've devalued your savings. They've taken away 40% of your life's effort in 2 years. I mean, and that's just wrong. I mean, it's just deeply fundamentally wrong. And so, we got to stop the system, because the next print, which is mathematically inevitable, in my view, is going to come, and it's going to be bigger than the last one. So
there is the biggest, let's say, threat to America, or the biggest problem that we have right now. Is it inflation?
I think it is. I think it's the fundamental underlying problem. I think it's why politics are so dysfunctional. I think that it's led to the massive wealth inequality that I think is dysfunctional. It's gutted the middle class. I mean, the advantage I have over you, and probably some of the listeners, maybe not all of your listeners, is, I was around in the 70s and 80s and 60s to a small degree. I was born in 57. It was a better country back then. There was a middle class. There was just a lot more flatness in terms of earnings. I mean, the chairman of Ford, or president of Ford, lived down the street from me in Ann Arbor, and his dad probably made 5 or 6 times what my dad made. My dad was a shopkeeper. So, today the president of Ford makes 400 times what the average salaried person makes. I mean, there's been centralization and concentration of wealth at the top, and that's occurred as a result of the monetary system favoring those people. I mean, we don't really have a truly capitalist system. We have a crony capitalist system that benefits the rich who know how to play it and play it well. And it disadvantages just the guy who gets up and goes to work and earns a wage, because all he knows, he goes to the grocery store and everything costs more,
I think we're really starting to see that, let's say, that manifestation of that particular system, that crony capitalist system, with all of these, let's say, uncoverings of this USAID program.
Well, that's right. I mean, the corruption is all over the place. And, I also point out how the numbers are cooked. I mean, they tell us inflation is 2 or 3%, but we all know that's not really true. I mean, my homeowner's insurance went up 100% last year. My auto went up 30. I mean, and wage earners have been very badly hammered, and the Fed's saying we're going to get back to 2 or 3%. Well, I want to ask the Fed, okay, guys, we're going to get back to 2 or 3%. Now let's take the longshoremen in the United States. These are the guys who work in the ports and unload stuff. They just got a 6-year, 60% wage increase. So their wages are going to go up 10% a year for the next 6 years. Well, that's a long way from 2%. And so what I'm suggesting, and what I believe, is that the disinflation that we enjoyed post-Volcker from early 1980s until 2020, that's over. And the new trend is an inflationary trend until we solve this problem. And so, the reason for the book, again, was it's timely because I want to try and help people figure out how to protect themselves. from this inflation. And the two best protections, I mean, gold is the best non-volatile form of protection. And then, the more volatile but potentially larger protector is Bitcoin too. So,
Larry, we were talking about the idea of the wealth gap, the CEO of Ford living down the street from you guys. How does this wealth gap really, let's say, start to manifest within society and therefore through the political system as well?
Well, I mean, any observer of United States politics knows that it's just become a complete catfight. I mean, it's just really ugly, and it's just people are economically hurting. I mean, we're now looking in America at the first generation that may not enjoy the American dream, where my kids may not be able to live as well as their boomer parents, or young people can't live. And the reason for that is, again, the broken system. And so you see it. I mean, I think a lot of the dysfunction, as I said, part of the reason I wrote the book is this is not the America that I grew up in. Mm-hmm. And I want that America back. I want a nicer society, a nicer, fairer society. And unfortunately, I mean, so when you hear the left and the liberals, the progressives arguing about what's broken, I mean, they're not entirely wrong with the unfairness. Mm-hmm. They just have, in my opinion, the wrong solution, which is they want to hand out money to everybody, and they want to tax the rich, and they're looking at the same broken system. They just have the wrong solution. The solution is to return to a sound monetary system, and then things will be much more equal. Mm-hmm. And so that's why I think Trump had the comeback that he had, because a lot of people just looked at the other side and said, "You guys don't get it. I'm getting roasted here by inflation." So that's, to me, the broken money is really, I mean, my tagline, I borrowed it from another guy on Twitter, but my tagline is "Fix the money, fix the world." I mean, it was interesting to me, Tom, I'll make a comment. We had a presidential debate between, Trump and Kamala. Neither of them, and they don't dare go there. It's like the third rail. Nobody talked about the debt. Nobody talked about the interest expense. Nobody talked about the fact that the federal government is really kind of out of control, the spending. I mean, we grew the spending in COVID massively. Understandable. It's a crisis. But one would think that, okay, the crisis is over. Let's take the spending back down. No, it's grown. And for the first 2 months of this calendar fiscal year, federal government, the federal budget went up 64% in November and December of 2024 compared to the prior year. Mm-hmm. I mean, it's kind of like, oh, wow, it's not only not getting better, it's in fact getting worse. Now, in that breath, and maybe where you're going to go next, and I'll just preempt you and address it, Doge is a positive concept. I mean, I get, and as you say, they're digging in, they're finding fraud, and there's no doubt it's good, and they will definitely slow down the trajectory of this. But we're pretty far gone. And Elon's being an optimistic entrepreneur when he says we can take $2 trillion out of the federal budget and we'll balance the budget. No, I mean, we could, if we wanted to cut Social Security, Medicare, and defense spending by 40 or 50%. But if you look at the political situation, constellation in the United States, the odds of that, while all the boomers are alive, is pretty low. Mm-hmm. They don't have the votes to do it. So therefore, I think what they're going to continue to do is keep spending. And then that, of course, takes us to a debt doom loop, and that, takes us in a lot of unpleasant places. So, but, it doesn't have to be a bad outcome. I mean, a monetary reset could occur, and we could return to sound money. If you look at countries that have gone through inflationary problems, when they return to sound money, things do get better. And therefore, the book is a plea for people to become aware of the problem so that we start voting for politicians who are in favor of sound money.
So, Larry, you just mentioned that we had this big print since COVID, basically, and right. That's only exponentially grown at this point. So, are we on the brink of another monetary crisis here? Like, why
it feels
is it
that way to me? I
now?
mean, look, I don't want to be Chicken Little, and I don't want to say the sky is falling, and I don't really know how it's going to play out. None of us do. But what I will say is that the monetary system, as we've constructed it, whether we have another big print and another, and we go towards hyperinflation, which is very much a tail case, it's pretty, that I can't predict, and that I don't know. And hopefully, Scott Bessent will understand that we need to do a reset, and maybe we'll do it. But setting all of that aside for a moment, what I do feel very highly confident in is that the math suggests that as the debt continues to grow the way it's been growing, if we don't increase the base money supply, we're now at the stage. There's a good chart in the book where a guy, I'm forgetting his name now, but one of the guys did a study where he showed countries where the debt had grown to over 130% of GDP, and we're at about 125 right now. And in every single case, you had either very high inflation or some kind of a monetary event or collapse. And so we're kind of there. And, look, I thought, but to be fair to all the listeners, I thought we were there in 2008. And there are people who say, oh, they can kick this can for another 10 or 20 years. And you know what? Maybe they can. Maybe they can. But I'm pretty sure they can't kick it without more inflation. Mm-hmm. So, whether we go to a full-fledged crisis and another enormous print quickly or not, that's yet to be determined. But I'm pretty sure that we do have inflation in our future. And so given that drives where you want to be investing. And of course, the first thing it says is you do not want to own any long duration bonds. Equities, slightly different case. Of course, my preference is sound money and sound money equities, which is why I manage a fund that focuses on gold and silver mining companies, because they are mining what really traditionally has been money. And by the way, they're also terribly undervalued right now. So to me, anybody who doesn't have things, I say to my clients, I say, guys, you want to own things the government can't print because the government mathematically has to print. The question is at what rate? Slowly or super rapidly? We don't know. We just don't know. But they're going to print. We do know that. I think the math suggests they have to. So,
has this inflation, let's say, really become a moral issue, Larry?
I think it has, and I wrote a chapter on that. It's a form of taxation that people don't really understand, and it really benefits the wealthy at the expense of the poor. America was founded on the principle that all men are created equal, and you're supposed to have a fair system and a level playing field. And when you give insiders and wealthy people the ability to borrow at the Fed funds rate, which at times has been as low as 0, and you say to the guy who's working on the assembly line, the only rate you can borrow at is your credit card rate, which is 25%. Mm-hmm. That's not the same deal for both people. That's an unfair system. Mm-hmm. And so that, to me, that's morally wrong. And the book takes you through the history of all of this. The founding fathers knew this, and that's why our Constitution says that only gold and silver can be money. Actually, they even had a clause in the 1792 Currency Act where they said anyone who was known to debase the money, it was punishable by death. And Edwin Griffin wrote The Creature from Jekyll Island, and he had this wry comment in there. Says, if we applied that today, the entire Senate, the Congress, the Treasury Department, and the president would all be subject to the death penalty, which, obviously that's long since passed. But the point is, yeah, it's just not fair. It's just not. And so, it's a form of cheating that the wealthy use against the poor. And yes, in my view, therefore, it's an immoral system.
Larry, where did this debt-based monetary system come from? And why haven't sound money ideas won out if they're truly that much better?
Super great question. Boy, you are the perfect straight man, Tom. You have read the book and you know where to go. So Keynes, John Maynard Keynes, was really the big progenitor of this idea that we could print money in downturns and that would help solve these downturns and create animal spirits. And that inflation is absolutely necessary. And the Federal Reserve has basically said we need a 2% inflation target because otherwise we have the risk of deflation, which is total horsepucky. That's just not true. But Keynes said it. We've followed it. People have been indoctrinated to believe it. And I've even got a section in the book where I talk about the way that the Federal Reserve spends a ton of money funding and supporting the monetary economics chairs and seats and journals and so forth to support this existing system. And so that the Austrian economists who have the right view of how the monetary system ought to operate are marginalized and called cranks and conspiracy theorists and everything else. So the Fed has used government tax money to smother the opposition and the alternative case. And this book writes, quote unquote, the alternative case and shows how that has taken place. And, we've got to unlearn some of these old lessons. I mean, people think deflation is bad. Deflation is actually good.
Mhm.
Deflation is what's happened to your TV and your cell phone minutes. I mean, I was in college. I could call my parents for five minutes because long distance calls were expensive. Now, you can call people all over the world infinitely, and you don't even think about the charge per minute. That's deflation. Computers, TVs, all of it. That's what technology can bring. And Jeff Booth makes the great point that basically we're trying to run a monetary system that actually requires inflation on top of a world that has technology which is relentlessly deflationary.
Mhm.
And so the two are, quote unquote, in conflict, and they don't work. And that's why this whole thing just keeps getting worse and worse. I mean, there's a chapter in the book called Embrace Deflation, which is what we need to do. I mean, throughout the 19th century, we actually had periods of deflation, and living standards got better, significantly better. And we can have that again. I mean, I often say to myself, in the 70s, I mean, I look at the world today and I think it's a lot more unbalanced, a lot more unfair. But the advantage we have today is we have these enormous technical advantages that, we didn't have the internet in the 70s. We didn't have, I mean, all the stuff we have today technologically wasn't available. And, so when you consider all these technologies that got developed, we all should be working 10-hour work weeks because of all the productivity that these technologies brought. But we're not, because all of that productivity gain got raked off by the top and the people who own all the equity and so forth. And another chart in the book that I think is an important chart, and it goes to your quote unquote dysfunction. Why are things broken? And when I saw this chart, I just almost fell out of my chair. The top 1% of America owns 92% of the wealth. And that number has gone up 10x since 1990. The bottom 50% of America owns 10% of the wealth, and that number has flatlined since 1990. That's just not fair. That's just not right. And you don't solve it with taxation. No, you solve it by having sound money, because it's the wealthy who know how to game the broken money.
Mhm. So, when we look back, let's say over the history of fiat currencies, there's 600 something currencies over the history of the world. And Mike Maloney's history of sound money, or I can't remember the name of the series.
A lot of respect for Mike. Yeah.
Yeah, it's a wonderful series, and everybody should use that as another tool to learn about this as well. But in there they go through this idea that there's been so many of these fiat currencies. Why is it that all of them end up failing and all of them end up starting from a place of sound money? So why is it that this system that, let's say intuitively makes sense to us, why is it that this seemingly better system constantly gets subverted by this fractional reserve lending system?
Yeah, it's a great point. I mean, it's just because the people who are in political positions of power have the abilities to change the rules in their favor. And so, I mean, first of all fiat currencies that we know of today have failed, with the exception of the British pound, which has been around since the 1600s, but it's been massively debased. They either fail or they're massively debased. And, what it is, Tom, is that, being on sound money requires discipline on the part of banks and the government.
Mm-hmm.
And guess what? As it turns out, those guys don't like that. The government likes to spend money. They like to buy votes. They want to remain in power. And the banks, I mean, the reason the Fed was created was the panic of 1907 caused the New York banks to come within a hair's breadth of being bankrupt, and JP Morgan bailed them out personally.
Mm-hmm.
And the reason that occurred is that the banks cannot control their ability to create fractional reserves and create debt, because it increases their profits. I mean, and this goes back to even the old goldsmiths, who they would take your gold, they would put it on deposit, they would lend out money against it, and they lent out more than they had. I mean, in fact, we're seeing this right now in the gold market, because, as you know, there's kind of a small run on the LBMA, and we know there are a lot more paper claims for gold than real gold. And this is the constant problem. And when the bankers and the government got into bed together when they created the Fed, and it was a good deal. The government got their wars paid for, and got the power to buy votes and, run the system. And the bankers got a heads we win, tails you lose deal where they could lever up and try and make as much money as possible when times are good. But if they took too much risk and got over levered and they were at risk of failing, kind of what happened in 2008, they got bailed out. Mm-hmm. In 2008, they paid out $20 billion of bonuses to the bankers. There's one of my favorite photos in the book is the photo of the guy, the California veteran who lost his house in the GFC, and he spray painted on the garage door, 3 tours in Iraq, but no bailout for people like me. And, that just pretty much sums it up, doesn't it? I mean, all of those bankers should have lost their jobs, but they didn't. They got to go back and do it again. But, average Americans who got sucked into the housing bubble, paid too much for a house, got over levered, they ended up losing their house. And, it's just wrong. I mean, it's just fundamentally wrong. Anyone looking at it objectively can see that. Now, there are people who say, well, Larry, you had to do that. If we hadn't bailed them out, the whole world would have ended. And I say, horsepucky, that's just not true. That's nonsense. We could have very easily, nationalized those banks, brought in small town bankers from the Midwest or from the South to run them, let the big guys who would run them into the ground, kick them all out and gone back to a sound money system. But we didn't. We bailed them out and we let them do it again. And here we are.
Here we are with a unbelievably devalued currency over that time as well. And correct. I want to get your take on how this measurement of inflation has changed over the years to, let's say, understate what is actually happening.
Yeah, thank you again, man. I love you. You are the best straight man. So there's a chapter on inflation, and it's really, really fascinating because we all know they say inflation is 2 or 3%, but everyone can point to something in their life that's gone up a lot more than 2 or 3%, right? Mm-hmm. And they have all these tools for doing it. They have, and they're laid out in the book, and it's probably too lengthy to go into in this interview. We could spend 20 minutes on this, but they've got something called hedonic pricing, which, the price of cars is a good example from Bill Fleckenstein in there in the footnote. But, the price of cars went up, a huge amount over a 10-year period of time, but the CPI price of cars went up a fraction of that amount. And what they do is they say, well, it's a better car, so even though it costs more, now you have anti-lock brakes, so it doesn't really cost more. You got a better product. Mm-hmm. So that's just one way. The other thing they do is they do a substitution effect. They'll put food in there, and so the price of beef goes up, and suddenly you're paying more for your steaks. Well, maybe the price of chicken or pork went down, so they throw the beef out and they use the chicken as the measurement, right? I mean, these kinds of things. Shadow government statistics is the best chronicle of these types of things. But, the government lies to us about inflation. And so, again, we've all been suffering from this. We know it. We feel like we're being lied to. I think earlier in the talk, you said, we all kind of sense something's wrong, but we can't really put our finger on it. Mm-hmm. And again, the aim of the book is to try and help their average person to put their finger on it, maybe even to make them mad enough that they say, God damn it, this isn't right. And then maybe even to get them to say, okay, well, I know I'm going to protect myself. I know what I'm going to buy to protect myself. But also, the next time I see a sound money politician, I see a Thomas Massey or a Rand Paul or, I don't know. I mean, anybody. I mean, RFK gave a great speech, about sound money. I'm going to support that person because they get it. They understand the way the government cheats on this stuff, and it's hurting me. I mean, I'm hurting. I mean, one of the great tragedies, Tom, that I see, and I think it's just awful. I'm going to just turn that off. One of the great tragedies that I see is people in my age set who've worked their entire life, made a fair amount of money, not a lot, but a fair amount of money, maybe have their house paid off, and they know they might live another 10, 20, 30 years even. And they think to themselves, well, yes, I've got some nice savings, but will they be enough? I can't. I mean, I know guys who, most people would say objectively, well, you got enough money, you can retire. Well, and they're smart and they're sitting there saying, no, I can't. Mm-hmm. What happens if the price level doubles? This isn't enough money. I actually saw this happen with my father. He retired with a fair amount of money and just a nice little nest egg from having worked his entire life in a business. And, by the time he passed, that money had gotten whittled away and its purchasing power had gotten whittled away. Again, very, very unfair,
Larry, on the other side of inflation, though, we always hear from let's say the Fed that deflation is a horrible thing. Is there a difference between deflation in a debt-based monetary system and a sound money system?
There is. I mean, in a debt-based monetary system, when you have very severe inflation, you get the Great Depression. And that's what the Fed and others use as the bogeyman to keep us in this inflationary loop. Oh my God, if we do that, we'll have another Great Depression. Mm-hmm. And they're wrong. I mean, that's just not a true statement, but they've managed to scare everybody into requiring inflation. In fact, recently, some of the Fed people and others have said, well, maybe the 2% target's too low. Mm-hmm. Maybe we need to go to 3 or 4%. Well, why not go to 5%? Why not go to 10%? I mean, it's ridiculous. But when you're on a sound money system, what savers get rewarded, and your money and you have deflation, productivity goes into making things more cheaply and efficiently. And so your money buys more goods and services. So it's a good kind of deflation, not the catastrophic bad kind of deflation that occurs when the credit bubble of 1929 bursts. Let me say, Tom, let me just go back to the kind of first principles. Interest rates are set by the Fed. The Fed, has had interest rates as low as 0% and as high as 20%. I mean, it's kind of like, just out of control. I mean, 0% interest rates, that's ridiculous. It's like saying money is free. And 20% interest rates, that strangles the economy, but it definitely brings inflation down. And so the interest rate is the price of money. And the rate it ought to be set by the marketplace. I mean, we all know that price fixing doesn't work. I mean, Soviet Union set grain prices, and they set them too low, and they had a starvation. Free markets are the best way to set prices. Well, the free market for money should set the interest rate at the balance between what savers require to put their money into a project and what investors are willing to pay because they think that project will generate a greater return than the cost of the interest. And that's really what's wrong. If we want, capital allocation is the most important decision that any economy makes. And if you set the interest rates at the wrong place, you get total misallocations of capital. In other words, we put money in the wrong thing, and therefore society doesn't benefit. And so it's kind of arcane, but I try to explain it in the book in simple terms, that having a free market for interest rates set by the marketplace, not by the Federal Reserve. I mean, the book actually calls for, I give a speech in the book about what the president might say. The book actually calls for unwinding the Federal Reserve and just letting the free marketplace set the interest rate, not some group of 12 people in the in the Fed offices in DC. I mean, we've got 330 million people, and we've got these people setting interest rates. It makes no sense. Even if their intentions were good and they were omniscient, they were geniuses, they couldn't do it. You just can't do it as well as the market can do it.
So Larry, let's move to some of the solutions as you laid them out in the book. I think most people that listen to this show are aware of the problem. So what are the solutions as you see it? And, is there a lot of pain to get there, let's say?
Well, let's talk solutions first, and then let's talk transition and pain and how we get there second. Okay, so let's just talk solutions. The first solution, and I always tell my clients this, is in a mathematically driven system where they have to continually generate inflation to prevent a collapse, and we're pretty sure they won't let a collapse take place, because they didn't in 08 and they didn't in COVID, you need to own things that the government can't print. Okay, so real estate's a solution, a negative, and I deal with that in the book, but the negative there is it's got taxes and carrying costs and so forth. But the most obvious solutions are what I consider the two forms of sound money, three forms of sound money, really, gold, silver, and Bitcoin. Gold and silver are analog sound money, 5,000 plus years of history. Everybody knows their money. They can't be debased. You know what they are. And Bitcoin is a new and emerging class of sound money, still emerging, still very volatile and risky, but it's a digitally scarce asset. And when Bitcoin got invented, they invented digital scarcity. This is a big deal. Before the airplane, people didn't fly. After the airplane, people flew. Mm-hmm. Before, Bitcoin, there was no digital scarcity. And a lot of people tried to create it. And there was a problem called the Byzantine generals problem, which is how do you trust a lot of people you don't know, but they're not going to cheat? And that's what Bitcoin solved. It was a mathematical problem that Bitcoin solved. And so in my opinion, the two soundest solutions to the money, to the printing are, Bitcoin and gold. Now, and by the way, gold has done a fabulous job of protecting you from debasement since 71. It's basically tracked with inflation. It's a little behind the stock market if you reinvest dividends on a tax-free basis, but they're actually relatively close. So gold is kind of your, in my view, it's the new bond. It's safe. The volatility is low. The biggest drawdown is, maybe the 1 year after 1980 where it got drawn down in the 20 or 30% range. But in general, gold's up 66% of the years on balance. And then the other 33% when it's not up, it's not down by much. So gold protects your purchasing power. Bitcoin's kind of like a growth equity. It's kind of becoming the newer form of gold, a digital form of gold. And young people seem to prefer Bitcoin to gold and it's got advantages. You can see, the blockchain, you don't have the paper gold problem, et cetera, et cetera. So these are the two solutions that I recommend highly, and the book talks about both of them extensively. Let's talk about your second question. How do we get from here to there? Well, I don't know, and nobody does. Mm-hmm. And it's going to be painful. It's going to be somewhat of a mess. There will be some winners economically, and there will be some losers. I think the biggest losers will be the people who own long-term bonds, because I think it's almost a certainty that those will be devalued in terms of real purchasing power. Now, if you own a government bond that's 20 years long, I'm sure the U.S. will be here in 20 years, and I'm sure they will pay you back the $1,000 or the however much dollars you put into it. But what we don't know is what that'll buy. Is that going to buy you X gallons of gasoline or Y cartons of eggs or whatever? My sense is in 20 years, it'll buy you a lot less than it buys you today. And so, in the transition, it can happen a lot of ways. It could happen in a messy way where we go from high inflation to potentially even hyperinflation, which I hate to even say the word because everyone accuses me of being a doomer. But if you look realistically at what other countries who have done what we're doing, what's occurred, we're doing the same things that Weimar Germany did. We are doing the same things that Venezuela did. We are doing the same things that Brazil did twice. We're doing the same things that Argentina did, which is to say, we are spending more than we have, and we're printing money to cover the gap. And if that gets worse and worse and worse, eventually people are going to say, I don't want to hold these bonds anymore. So they're going to go to the Federal Reserve, and the Federal Reserve interest rates are going to go higher. This is the debt doom loop. The Fed is going to be forced into printing even more money, to buy the bonds to keep the interest rates under control. And as you can see, you get a reflexive circle where, they print more money, interest rates go higher still, the budget deficit gets bigger. That means they have to sell more debt to cover the deficit, which goes into the bond market, which is of a limited size, which means interest rates have to go higher. I mean, you can see you've got a negative feedback loop that in other countries, historically, has led to hyperinflation and currency collapse. Could that happen in the United States? I don't think it will happen, but it's a tail case, but I don't think it's impossible and I think we are trending in that direction. What I think and pray will happen, which is a much more orderly solution, is inflation will get worse. Politicians will wake up to the fact, all of us will wake up to the fact, we will start demanding politicians reset the currency. And what do I mean by that? That they return to a sound money standard. They say the dollar is worth X amount of gold or Y amount of Bitcoin or some combination of the two. Mm-hmm. Now, what will happen the one time they do that, it'll be an inflationary event. Let's not kid ourselves. It'll hurt. Mm-hmm. It'll hurt badly. However, then you'll actually be on a sound money system. And, there have been plenty of countries who've had currency events. I mean, a recent one was Ecuador had one in 2000, and their currency failed. It was brutal. Everyone who had the currency got wiped out. Mm-hmm. But then they decided to adopt the dollar-based system. Ecuador's thriving today. So, when you return to sound money, health returns. I mean, most people just want to get up in the morning, go to work, do their job, get paid fairly, and have money that they can trust, right? So that's the other side of this fourth turning, and I look forward to it because things will be really good. But frankly, we do have to get from here to there. And I think I'd be blowing smoke up everybody's skirt if I said, "Oh yeah, we're just going to make this transition. There's not going to be no pain." No, we've had a hell of a keg party here. You know what I mean? I mean, people are really, really drunk on debt, and a lot of that debt just isn't going to get repaid in fair terms. That's just the fact. So, there's going to be a hangover when all this debt comes to roost. Now, once again, I don't know when it's going to happen. It hasn't happened yet. I thought it was going to happen in 2008. I was wrong. My gut is it kind of happens before the early 2030s. that we're in it right now and that this is going to come to a head in the next 5 or 6 years. Part of the reason why I say that, Tom, is that look at the price of gold and look at the price of Bitcoin. They are kind of the two alarm bells. They're like the canary that's falling over in the coal mine to tell you that there's dangerous gas. I mean, they're both at record highs, even with real interest rates going up. And it's kind of like, hang on a second, inflation's going down, interest rates are pretty high. These things should not be going up, and yet they're at record highs. That's, to me, a big clue that something is broken and that the money is kind of in the process of breaking, right?
So how do we reset to, let's say, a gold and or a Bitcoin standard, let's say?
Well,
are we going to use them as collateral to back bonds? How do you see that working?
Yes. I mean, Judy Shelton came out with a great idea of issuing gold-backed bonds, U.S. gold-backed bonds. It's brilliant. It's a great idea. That would be one way to do it. Another way to do it would just be to peg the currency to some version of these two assets. And then suddenly the government can't print money anymore. I mean, because they don't have it to print, or if they do print money, the value of these assets go up a lot. So, and ultimately, I think the dollar, there will be an old dollar and a new dollar, and maybe someday there won't even be a dollar at all that will be pricing things in, a quarter of an ounce of gold or X number of Satoshis, which is a fraction of a unit of Bitcoin. But, the monetary system has to be anchored to something that politicians cannot debase for health to get restored to the economy. And as I said, there are a lot of ways to get, but we've got a president and a Treasury Secretary who have indicated a more than casual interest and notice that this is an issue. And so it would not surprise me to see some moves. As an example, in the United States, they talked about establishing a strategic wealth fund, and they're calling it a crypto reserve, which I hate because I'm a very strong believer that all crypto that's not Bitcoin is not good. It's fraudulent. But, they are very much aware of this issue. The Pentagon's aware of the issue. The CIA's aware of the issue. The military's aware of the issue. There's a guy named Jason Lowery wrote a good book on this issue. And frankly, China and Russia and the Middle East are aware of it too. And that's why they're stacking so much gold. Now, China is making a bet on gold. They do not believe in Bitcoin on China. I think Russia does. Putin has indicated he gets it. We see a lot of hash rate out of Russia. I think Russia's probably stacking Bitcoin. But, if we want to leapfrog the countries that have bet on gold, we should actually just skip the gold reset and go to Bitcoin, which is entirely a possible move. But I don't know, Tom. I mean, it's probably too early, and it's probably a dream that Bessent is going to have the political clout to pull this off now. I mean, sadly, as we all know in politics, big things don't really happen until there's a crisis, And so sadly, I think we're probably going to have, a bit more of an inflation crisis and a debt crisis. And maybe that will lead, and that's part of, again, why I wrote the book, get everybody knowledgeable enough so that when that occurs, a lot of people stand up and say, damn it, this inflation's killing us. Would somebody please take us back to sound money? Please. And, if there are enough of us, I mean, right now, I'd put the people who understand this issue at maybe at the 5% level, maybe higher, maybe lower, but certainly not big. So we got to get a much bigger groundswell of people who understand the issue. And then we'll have politicians who will stand up and say, well, I want to be elected. And I know that one way to get elected is to be a sound money person. So I'm a sound money person. Well, then people vote for them. And I mean, you can see where this goes, right? Yeah.
Larry, do you think that one of the advantages that Bitcoin does have over gold, and if we think about this in a deflationary way, you're going to need more resolution of money to be able to buy, let's say, smaller things. So is that one of the advantages of Bitcoin?
It does. It's more easily divisible. I mean, frankly, gold hasn't really been a part of the monetary system since the 1920s. I mean, my grandfather told me about paying for things with gold coins, but I mean, you and I mean, gold coins are, they're collector's items now, right? I mean, there's nobody who pays for anything with gold or silver, I should say it's very rare, right? And it's, while we know a coin has the value that it has, it's hard to divide it up. And that's why silver has a lot of value in smaller transactions versus gold. And it's kind of more the people's money. But the beautiful thing about Bitcoin, for those who aren't aware, is that each one Bitcoin represents 100 million Satoshis. A Satoshi is the smallest unit of account in a Bitcoin. So it can be divided up a lot. And
What is it,
so,
8 decimal places?
yeah, so I could send you 1,000 Satoshis or 2,000 Satoshis or whatever it might be. And, and that's a very easy transaction to do. Now, one thing we should talk about here is obviously today Bitcoin's not really being used heavily for transactions because the main chain, the main blockchain that Bitcoin is running on settles every 10 minutes. And the average transaction cost right now, I think, is running around $3. Well, you're not going to buy a cup of coffee with a transaction that takes $3 to do it. However, as we also are aware, many people are aware, there's a layer 2 network forming over and above Bitcoin called the Lightning Network, which settles back to the main chain at indeterminate sporadic periods that can basically process a small transaction. I bought coffee with a Lightning transaction, and the cost is a penny for that transaction. And so, and that's coming. But we need, this, I've often said, and I was an investor in the internet back in the day, I've often said this kind of reminds me of the early days of the internet where you had dial-up and it was clunky and the browsers didn't work very well. And Bitcoin's still in the early days. For the first 5 or 6 years, it was a complete experiment. And I remember talking to people and they're like, well, I don't know if this is going to work or not. But we're out of the experiment phase. We've now got, it's now an asset. We've now even got the US SEC saying it's a commodity and they allowed ETFs, big steps. And so now that we have this thing and it truly is an asset, the next move is for it to become a form of money that you can transact with. But that's going to take technological time and development for these Lightning solutions to get better. It's very easy to buy coffee with a Lightning transaction. I did a Lightning transaction where I tried to send somebody $2,000. It worked, but it took about a day and it cost a lot. And the reason is there wasn't enough liquidity in the Lightning network. So, that's, like I say, we're early days on using Bitcoin to buy for things. But if you map out the way, think of the original cell phones. I was out when the original cell phone came around, the one that Michael Douglas was talking on in Wall Street. I remember that cell phone. My boss had one. He was a master of the university, made a bunch of money. And I think it cost $1 a minute to talk on that thing when he first, so he'd make a 10-minute phone call. It was $10. Mm-hmm. Of course, now you got your cell phone, you pay $35 a month. You can make an unlimited number of calls anywhere in the world. Same thing is going to happen with Bitcoin. This is going to get cheaper, easier, faster. Everyone's going to be able to use it. Mm-hmm. But, you got to give the technology guys time to develop, those solutions.
Larry, I want to kind of, let's say, wrap up with this idea of asking if other countries can kind of do this monetary reset, or if the reserve currency of the world has to do it. Like, can China come out and revalue gold and that become kind of the new standard that everybody starts using? Or is it the US that has to take the lead in that because of the rest of the world needing dollars at this point?
So that's a great question, Tom, and it's a little bit of a chicken and egg question. So the dollar has been the world's reserve currency, and it's losing that status since we grabbed the Russian bonds in 2022. Oil transactions used to be 95% dollar-based. They're now 65% dollar-based. Other countries realize what we've done to our currency, and they're trading away from the dollar. The world needs a neutral reserve currency. The world needs a reserve currency, and of course, it's been the dollar since we had the Bretton Woods system, and then the petrodollar, which kind of came after that. What's going on right now is that system is fading. It hasn't been replaced; it's still there, but it's fading, and we're getting into what I would call a multi-currency world, where the Chinese are buying oil from the Saudis; they're paying in yuan. If the Saudi guy doesn't need a piece of Chinese equipment, he might say, fine, take that yuan and convert it into gold. I know the gold will hold its value. Before 2014, he might have said, take that yuan and convert it into US Treasury bills. Well, he probably would have paid for it in US Treasury bills. China would have transacted with Saudis in Treasury bills, but in US dollars. But, what I think is going, and so your question of, do we have to reset it or can others reset it first? Well, the others are kind of already resetting it. The trend is away from the dollar. And so I think we're going to live in a quote unquote multi-currency world where you're going to have, the dollar, the yuan, the euro, the Japanese yen, gold and silver and Bitcoin are all going to be kind of competing for being the monetary solution. And, my view is that, in terms of neutral reserve assets, the two that fit the bill are gold and Bitcoin. And so their relative share of all these transactions is going to continue to grow. But let's be fair and honest. We are a very long ways away from having the dollar fail as a reserve currency. It's just, but you can see, once again, you can see the trend. The trend is the dollar is losing market share. And the reason for that is because of the way the US federal government is behaving. And, these other countries aren't stupid. And they're like, hang on a second. Putin even said it. Putin's, not a good guy at all, not somebody I like or support, but not a stupid man. And he said, why should I hold anything that, the West, the US dollar, which is just programmed to debase at 7 or 8% a year. He literally said that. They get it, and more people are coming to see it in that way. And so, this extraordinary privilege that the US had where we could print these dollars and send them around the world and get people to send us their exports for dollars, that's not going to be so easy when they say, I'd prefer you don't pay me in dollars. I'd prefer you pay me in gold or Bitcoin. And that's happening.
Well, for anybody that's interested in this book, there's a ton of nuance, a ton of color between all of the topics that we hit here today. It is really worth checking out. Again, the title of it is The Big Print: What Happened to America and How Sound Money Will Fix It. Larry, I really appreciate your time and going over the book with us today, and I hope it's a good success for you.
Well, thank you, Tom. I do too. I want to try and help as many people as possible, and I just ask everybody listening to really seriously consider the war for sound money, because I think it's the thing that will make the world a better place. And that's, I feel like I got tapped on the shoulder, and that's why I wrote the book. So I really appreciate the time on your show, and I really appreciate all the support. You've been a great channel for me over the years. I think I've been doing these things with you for 5+ years, and you never waver and you get it. So I'm deeply appreciative to you for all that support.
Well, Larry, I'm appreciative to you to help expose our listeners to a lot of these ideas and some different ideas as well, and explaining this stuff to us, because it is so necessary. And I think the more we do this, the more people start to get it, and the more people start to also demand change, which is extremely
and that's how we're going to make the system better. Thanks, Tom.
Always a pleasure, Larry. Of course, on Twitter at Lawrence Lepard and EMA2.com.
Actually, if I can jump in there, Tom, I might just say, I don't know when this is going to come out. I've been Twitter hacked. Even though I had 2FA, I'm Twitter hacked. I'm not. If you go looking for me, it'll say there's no such account, which is extraordinarily frustrating. I'm hoping to get it resolved, but the Twitter customer service isn't particularly good. So the best way to interact with me is at my website, EMA2.com. You can send me an email. I'll do everything I can to respond to anyone who reaches out. And there's a lot of data on that website, by the way. We write a free newsletter with macro stuff and so forth. But so sadly, I'm not on Twitter. I would put in a plug here for those of you. I'm not sure if you've gone there yet, Tom. There's a Twitter alternative called Nostr, Nostr. And it's emerging as a very good alternative. And I am active on there. So, I think it's the future of these social media. It's like Bitcoin. It's distributed. Nobody controls it. So I think I'll be more active on there in the future.
Perfect. Well, I appreciate it, Larry, and I wish you the best with your
Thanks,
getting
Tom.
your Twitter
Really
back.
appreciate giving me the audience.
Wonderful. Thanks, Larry.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.